For institutional fixed income investors, managing credit risk requires quantifying an event that is notoriously difficult to predict: corporate default. To price this risk, analysts break it down into three absolute components: the probability of default occurring in a given year, the expected exposure, or the total capital at risk before any recovery, and the recovery rate, which is the percentage of capital salvaged if the firm actually fails. These components form the calculation for loss given default. By subtracting the recovery rate from 100%, analysts establish the loss severity. Multiplying that severity by the total expected exposure yields the exact dollar amount the investor stands to lose. By projecting this expected loss across each period of a bond's life and discounting it to present value, institutions arrive at a single metric, the credit valuation adjustment, or CVA. This diagram illustrates how the expected loss manifests in the open market. The precise gap between a baseline risk-free yield curve and a higher-yielding corporate bond curve represents the CVA. It is the excess yield demanded by investors to compensate for taking on the credit risk. Accurately pricing that yield gap forms the foundation of modern credit risk management. This requires mathematical models that translate financial data into precise probabilities. The first major framework used to calculate the credit valuation adjustment is the structural model. This approach relies on a specific options pricing premise. Debt investors hold a position that is effectively short a put option on the company's underlying assets. Looking at this balance sheet, if the fluctuating market value of a company's assets drops below the fixed face value of its debt obligations, a default is triggered. Shareholders then exercise their theoretical put option, surrendering the depleted assets to creditors, satisfying the debt. Because creditors bear the loss of receiving depreciated assets, the calculated value of this implicit put option is exactly equal to the credit valuation adjustment. However, this framework relies on two flawed assumptions. It requires companies to have extremely simple balance sheets, ignoring off-balance sheet liabilities, and it assumes that the firm's physical assets are actively traded with observable market prices. The structural model provides an elegant economic rationale for why defaults occur. But because corporate assets rarely have fluid, observable market prices, the required inputs are difficult to estimate, strictly limiting the model's real-world utility. To bypass the data limitations of the structural approach, institutions turn to reduced-form models. This framework abandons the put option theory entirely. In fact, it makes no attempt to explain the economic reasons why a company fails. Instead, reduced-form models focus entirely on statistics to calculate when a default will occur, treating the event itself as an exogenous, random variable. This graph tracks default intensity, the probability that a default jump will occur over the next small increment of time. This intensity rate uses regression models fed by highly observable data. Analysts input shifting macroeconomic variables and company fundamentals to constantly update the baseline probability. The primary weakness of this approach is its strict adherence to randomness. By treating default as a pure mathematical surprise, the model ignores the reality that defaults are almost always preceded by observable warning signs, such as credit rating downgrades. By sacrificing the economic why, reduced-form models gain the distinct advantage of utilizing live market data to achieve higher statistical accuracy. These modeled probabilities do not exist in a vacuum. They are constantly mapped onto living market data through the term structure of credit spreads. This chart visualizes the term structure, plotting a bond's maturity timeline against the market's credit spread. High-quality AAA segments maintain a flat curve, while the high-yield curve steepens aggressively, reflecting compounding default probabilities. During expansions, the spread compresses. During downturns, curves widen significantly. Beyond macroeconomics, two specific external factors actively distort the shape of these curves: imbalances in the supply and demand for credit, and sudden spikes in equity market volatility. The term structure is a live, aggregate reflection of the market's collective modeling for default probabilities and expected recovery rates. In a single-name credit default swap, Entity A pays a continuous premium to secure protection against a reference entity's default. If an actual default is triggered, premium payments halt immediately, and a settlement payout is activated from the protection seller back to the buyer. The exact size of this payout is strictly tied to the market value of what is known as the cheapest to deliver bond. The rules of the swap dictate that this specific deliverable bond must share the exact same seniority level as the original defaulted reference obligation. Immediately upon default and the subsequent settlement of this payout, the single-name credit default swap contract is permanently terminated. Modern credit risk management operates as a unified architecture. Structural analyses of balance sheets, stochastic models of default intensity, and randomized path-dependent simulations all synthesize to accurately price the underlying risk, the exact risk that derivatives like the credit default swap are built to transfer.